Hi again, Ed the Finance Guy coming back. I have a tax tip for you today. Remember, July 15th, income tax deadline day. Make sure you file. If you can't file, you don't know where your documents are, file your extension, get an extra few months. But if you can, get it over with, file your return. The question is, do I itemize? That is the question I hear most from clients. Should I itemize? Should I take what the government gives me, the standard deduction, or should I itemize? What exactly does that mean? What is itemizing? So now you have your tax return as Form 1040. On that return, you're putting your income on the front page. You're putting your W-2 income, your interest income, dividend income, Social Security, stock gains, losses, anything to do with income. You're putting that on the front page. And then you end up with what's called your adjusted gross income. Now there are some pluses and minuses to that number. But again, this is a video and it's a broad video about itemizing. When you itemize your deductions, you're saying, listen, I know the government is giving me X amount of money to write off, which means the first $12,500 you earn when you're single, actually $12,200 you earn when you're single, is tax-free. If you're married, the first $24,400 that you earn is also tax-free. So the government is saying, look, you have that $24,400 you don't have to pay tax on. But if you can come up with a larger number than that, you could use it to lower your taxable income. So if you can come up with deductions that total $40,000, instead of taking the $24,400 figure that the government is giving you, you're able to write off a larger amount. You're able to write off $40,000, which hopefully will give you a refund or will help you pay less taxes. Now, what is in that itemized deductions? What can I itemize? Can I have my daughter's wedding and put it on my itemization? No, but I've had people ask me that question. The four main deductions that you can put on an itemized schedule, which is the Schedule A on your return, medical expenses. So if you have any kind of doctor bills, dental bills, medical insurance, you could put that on a Schedule A, but you can't write off the whole amount. So for example, let's say you earn $50,000 a year. You have to multiply the amount of money you earn, or the adjusted gross income, by 7.5%. So if you make $50,000 a year times 7.5%, you can write off everything over $37.50. So that's what would count on the itemized schedule. So let's say your medical bills were $5,000 and you're making $50,000 a year. 7.5% of 50,000 is $37.50. 5,000 minus $37.50 is $1,250. So that $1,250 you put on the side on your Schedule A, which is part of your itemized deductions. Now again, this is for a married couple. So now you have $1,250 medical expenses. The next expense you can write off is mortgage interest. So you own a property, you're living in a primary house, you have a timeshare you're paying mortgage interest on, that amount is completely deductible. So let's say that number is $6,000. So now we're putting that on the side on the Schedule A. You have $6,000 in mortgage interest, you have $1,250 in medical bills. The total so far is $7,250. If you have no other expenses, then you would rather take the $24,000 that the government gives you as the standard deduction. Remember, you're trying to beat that number. They're trying to beat the $24,400 so that you can get a benefit writing off these expenses. The third expense is charity. When you give money to charity, which I hope everyone does, it's a good thing to do, you can write off any charity you give. Now, a lot of times people put down that they give clothes to Salvation Army. You can't count that value as it's new clothing. Remember, it's old clothing. So if you give a $500 suit to the Salvation Army, you can't write off the $500, maybe you can write off $150. Sometimes Salvation Army gives people blank receipts, which I don't recommend. You have to try to make a valuation what it's really worth and keep track of it, because if you get audited, they're going to ask for this proof. So let's say you gave charity, you go to church every week, or you tithe, or you're giving clothing, you're donating a car, whatever you're doing, you're going to itemize the charity, who you gave it to, how much you gave it to, and what the total is. Let's say for this example, you gave $5,000 in charity, which you're going to put on the side. So now you have $5,000 charity, you have $6,000 mortgage interest, you have $1,250 medical, so now you're up to $12,250, still under the $24,000 number. So far, itemizing won't help you. So the last on the list is taxes. Now for years you could write off whatever state and city withholding comes out of your W-2, that would be a deduction. So if you make $50,000 and you paid $1,500 to New York State, that's a deductible item, that $1,500. Along with that $1,500, you can write off your real estate taxes if you own a home, condo, co-op, plus any state and city tax that you paid on your W-2. Now it's capped at $10,000. So if you have $15,000 worth of real estate taxes and you paid $6,000 in state tax, totals $21,000, you can only write off $10,000. Now that has definitely affected New Yorkers. I have a lot of clients that ended up owing money because not able to deduct their real estate tax. Some people in Long Island have very, very high real estate taxes that they can't deduct. So for our example, we're gonna say we capped out, maxed out $10,000. So again, let's go over the numbers. Medical expense, $1,250. Mortgage interest, $6,000. Charity, $5,000. Taxes, $10,000. You add them up together. You got 10 and 5 is 15. 1,250 is 16,250. And 6,000. So you got 22,250. Now, the government is saying you don't have to pay taxes on 24,400. So you're going to say, well, I have itemized deductions of 22,250. You don't want to use your itemized deductions when you could use the government's, because remember, that amount of money comes off the income you earn. If you earn 50,000 and your itemized deductions are higher than 24,000, it's beneficial to itemize. In this particular example, it's not beneficial to itemize. It's better to take the deduction that the government is giving you. But it's a very important thing to do. It can save you a lot of money, especially if you have high medical bills or you have high health insurance or you donate a lot of money. So you give 10% of what you earn. It's a good chance you could itemize. So the best idea, but when you're doing your return, sit down with your accountant, go over your expenses, make a list of those 4 items. See if it goes over the $12,200 threshold if you're single, $24,400 if you're married. If you go over that number, you could itemize. So this is a tax tip. Remember, July 15th, file your return. Otherwise, file an extension. Just make sure it gets filed. You don't want to pay a penalty, pay interest. You want to get it over with, get it off your plate. It's already almost the end of the year, it seems like. In another few months, we'll be filing next year's return. Try to file it right away. Try not to file an extension. Again, I appreciate everyone watching. I've gotten many calls from clients. I'm getting very positive reviews. I'm happy it's helping. Even if it helps one person, I'm happy about that. If you have any questions, email me at ed1959@usa.com. I'll answer your questions. This is Ed the Finance Guy. Be safe, be smart, subscribe, and I'll see you next time.